This is Adam Lobel. I'm joined here with Zachary Ziskin and Justin Zeitchik, partners at IPRG. Each of us has over a decade of experience working in the New York City investment sales market, and we're coming to you today with an update on Q3 2023. We thought it'd be insightful to give you some market insight, what we're seeing, also talk about some trends in the real estate market. So this particular market update is from Q3 23 versus Q3 of 2022. It includes all multifamily buildings with 4 units and bigger, and all other investment properties. So that includes retail condos, any land sales, and office properties, in addition to any mixed-use properties. So across the entire Manhattan market, which we're focused on today, which is from the Upper East Side, Upper West Side, all the way down to Financial District, in Q3 of 23, there was 104 total sales. The number of sales was down 6.73% from last year. Sales volume was actually surprisingly up 8.58%. There was 1.19 billion of sales volume this year. And the average price per foot was hovering over $626 a foot, which was down from Q3 of last year, which was $843 a foot. So we broke this market report into basically 3 segments. We have the Upper East, Upper West Side, which is from 59th Street all the way to 110th Street on the west side, and up to 96th Street on the east side. Our Midtown cluster is basically from 14th Street to 59th Street, which encompasses all of Midtown, Chelsea, Murray Hill, Flatiron District, etc. And then our lower Manhattan is from Financial District up to 14th Street and includes the East and West Village submarkets as well. So the first specific submarket that we're going to talk about today is downtown Manhattan, which I mentioned is from Financial District up to 14th Street. Q3 of this year, we saw 47 buildings sell, which was a 10.65% increase from last year. The most active market, which has kind of been always to be expected, was the East Village, which had 11 sales, followed by Greenwich Village, which had 7. Sales volume was down about 20%. And we saw $365 million of transaction volume. And the average price per foot was just under $800 a foot, down quite a bit from last year, which was over $1,278 a foot. So what are some of the specific trends you guys are seeing in downtown Manhattan specifically?
So buyers and sellers are working to reconcile pricing amid the regulatory changes, the rising interest rates, and some of the turmoil in the banking sector right now. We see it as a perfect storm, a perfect opportunity for a long-term patient investor to enter the market. This is the time where you're able to buy a core piece of real estate in a prime market like Greenwich West Village. We're seeing an influx of foreign capital, private family offices out of Germany, Singapore, Israel, China, and Japan that are coming into New York and paying premiums and really competing to own these assets. I've been a broker now for 12 years, and this is the first time I've seen the ability to buy a building in Greenwich Village above a 6% cap rate. We took a sample size of rents looking at 2 bedrooms in the East and West Village. On a price per square foot on the west side, we're seeing rents peak over $100 a foot. And even on a prime 2-bedroom apartment, we're seeing rents approach $7,500 on the east side, similar size and unit, somewhere between $5,000 and $5,500.
Okay, that's great. So obviously those are some of the market insights that we find to be relevant, market trends in downtown. Next, we're going to jump into the Midtown market. In Q3 of this year, we saw a total of 31 buildings sold, which is down 19.35% from last year. I think the big drop-off here is from Hell's Kitchen. Last year we had 11 sales. This year we only had 4. And Chelsea was down from 11 sales last year to 8 sales this year. Sales volume was surprisingly up, though. There was $523 million of sales volume, which was up 35%. There was a handful of sizable transactions throughout Midtown and Chelsea, which really moved the needle in the sales volume category of this report. And then the average price per foot in Midtown was hovering at just at $654 a foot. So obviously Midtown Manhattan is a very unique submarket within Manhattan. What are some of the trends that you guys are seeing as it relates specifically to Midtown? And obviously the big one is kind of the office market and the lag thereof.
Going back on the uniqueness of Midtown, it really is a diverse cluster per se. You have Hell's Kitchen, which is 10, 15 blocks away from Chelsea, and both are two completely different markets and two completely different pricing. In Hell's Kitchen, we tend to see a lot of walk-ups that come to market, and these are selling at some of the lowest price per square foot in all of the city, compared to Chelsea, where you have transactions going for some of on the higher end, $800 to $1,000 a square foot. In regards to the office market, it's obviously struggling, especially Class B office product. A really good example of this, me and Adam met an owner right before the pandemic and the end of 2019. And I remember this very vividly. He had an $80 million LOI sitting on his desk from a very well-known REIT. And this building actually just sold at the end of Q3 for $37 million. And trust me, it was not easy for that owner to get $37 million at this point. So that's just kind of one example of how struggling the office market is for obvious reasons. The shift of the way people work after the pandemic, it really is here to stay. And it's also having a major effect on the local retailers that were once thriving in Midtown that are now struggling because their daytime traffic has reduced significantly from the daily commuters coming from Long Island, New Jersey, Westchester, and so forth.
Yeah, thank you for that. That's some really good insight on the Midtown market. Now we're going to kind of jump into the Upper East, Upper West Side. Some of the nicest and most beautiful blocks are at all of New York City. In Q3 of this year, there's 26 buildings that sold. This is down 23% since last year. Sales volume was $247 million, up 8.58% since Q3 of 22. The Upper West Side was the market that really moved the needle here, where sales volume jumped to $96 million from $40 million the previous year. And the average price per foot in this area is $922, which was actually an 11% increase from last year. So the Upper East Side, Upper West Side are performing very nicely, it seems like right now. What are some of the topics and trends that you guys are seeing in this particular submarket?
Yeah, so the key differences between uptown and downtown is the renter. You have a more established renter on the Upper East, Upper West Side, typically young families, or even on the older side. And a lot of these walk-ups that we sell specifically in the Upper East and Upper West Side are competing heavily with doorman elevator buildings. One interesting type of property that we sell pretty often are what we call quote-unquote covered land plays. And these are buildings that are situated or located on avenues, more specifically in the Upper East Side, that have extremely high FARs of 10. And an owner, and they're typically like family offices that come in with a lot of capital and buy these buildings at lower cap rates, which are today, call it around 5.25%, 5.5%, and they're getting a major discount on the price of the land for that future upside of assembling a block to eventually one day build a residential mixed-use tower. Obviously, there's like a lot of stakeholders involved to get to that point, but we've seen a lot of clients make some big returns in assembling sites and then reselling them.
Yeah, and we're certainly seeing a lot of developers target these kind of brownstone townhouse type of conversion opportunities, which are buildings that have 6 to 8 apartments in them. Where the highest use is obviously to gut those as single family and resell them for $2,000-$3,000 a foot.
Especially in the upper West Side, buyers in Lower Manhattan that might have been priced out for a single family conversion are seeking side streets on the Upper West where they can take a 4 or 6 unit building and perform that conversion.
Our team is tracking every single property that sells, and through this report we actually picked out a handful of transactions that we thought were kind of unique and kind of hit on some of the topics and trends and different market topics that we've discussed today. Justin, you want to maybe take us through the two that were downtown, and then we can jump to the Midtown, Uptown ones?
Yeah, I'd love to. So I want to start off with 473 West Broadway, which is in the heart of Soho. It sold for $5,750,000, which is the most eye-popping number here is $495 a square foot. Me and Zach were selling buildings in Soho, well over $1,000 a foot, not that long ago. This seller bought this building for $9 million in 2013, had a $6.5 million loan coming due, and couldn't even cover his existing debt on the property. And you see here, this building is a big building, but they're floor-through apartments, and you had two tenants in this building paying, call it, $1,000 a month that were occupying each, 2,500 square feet, which is like almost half the building. So, that's why it sold for such a low price point. And then 157 Rivington Street, very clean building, 15 of the 18 units deregulated, really, really nice renovations over there, sold for almost a 6 cap. And with our pro forma rents, we think that owner is probably to get that closer to a 6.5 cap. And the purchaser of that property is one of the most prominent family offices in New York City. And they probably own close to 100 walk-ups throughout Manhattan. And they bought this, I think they put down like 50% down to purchase on the acquisition.
Thank you for that. So, Zach, you want to take us through the two Uptown transactions that we found to be relevant?
Absolutely. So these are two deals that Justin, Adam, and I had sold this year. I'll start on the Upper West Side. We sold 2794 Broadway, a nice 16-unit on the corner of 108th Street and Broadway, a few blocks south of the Columbia University. So as you go up north there, you get a thriving market of renters, younger renters that go to the school and live in that community. So this particular transaction we sold for $9,510,000. 10 of the 13 units were deregulated. The main driver on this deal was the retail. There were 3 large retail spaces, and the corner was paying close to $25,000 a month. So we had to work closely with the landlord and the tenant in order to secure a lease to sell this deal. In addition, we spent significant time looking at the due diligence and historical documents on this building. There were rent reduction orders that predated the rent laws of 2019. So, it took time to really look through and prove that these units were properly destabilized. We sold the building at $607 per square foot, close to about a 7% cap rate. Buyer was a local family office that owns significant property on the Upper East, Upper West.
That was in a 1031 as well.
Another transaction on the Upper East, we sold 1711 2nd Avenue on the Upper East Side off of East 88th Street. What's interesting about this deal, it was a fully renovated free market deal, and the buyer had a vision. Justin was speaking before about covered land plays. The buyer saw an opportunity to own and cash flow on this property for the time being, and over time look to assemble a site for redevelopment down the road.
Thanks so much for that. I think we're going to jump into a handful of market topics that are relevant across the entire market. And I think one of the big things that I'm seeing and continuing to see is just a flight for quality, right? So we're seeing a lot of owners upgrade the real estate, selling the outer boroughs and buying in Manhattan, people that are looking for A+ real estate and selling properties that might be in a B or B- type neighborhoods. I think in terms of flight for quality, that comes into buyer demand for free market and gut renovated product, right? So if you have a free market, gut renovated building in a really good area of Manhattan, like it's the easiest exit because of the amount of foreign capital and investors looking to put money into that particular asset.
Yeah, I think also due to the higher interest rates, a lot of the buildings that we were selling in the past were what we call value add opportunities, and obviously those still exist. But I think it's become more attractive than ever just to buy something that's already cash flowing, free market, renovated, and buy at these attractive yields.
The challenge is, as you get up to 50% more in stabilization, all of a sudden your free market rents are subsidizing the rent stabilize and your income remains flat. So you're not getting that growth and appreciation that you once received years back.
So obviously, without any abatement, any new development in the city right now is condo development, and most of the projects are where the initial permits were filed are dating back to 2020, 2021. So obviously there's a major supply demand imbalance throughout Manhattan, which is obviously driving the rental market to historical highs. So the good news for owners is that they are getting the highest rents they've ever gotten, and hopefully that will continue. For the owners. Over the course of the next, 6 months to a year.
And beyond analyzing, the rents on a building, you really have to look at the operating expenses. A really attractive attribute on free market buildings is the protected tax class. You're capped at 8% annually and 30% over 5 years. When you're outside of that tax class, all of a sudden the taxes will increase astronomically as you make those renovations and increase your rents.
Yeah, so and then it's not just this quarter, but just in general since 2019. I think due diligence is key when determining the value of a building. What do you think about that?
Yeah, it's become an incredibly important part of the process. Looking back at documentation to support the destabilization of units. If we look at the Housing Stability Tenant Protection Act, owners are still reeling from that. They really took away all meaningful increases that you would receive on your rents from performing MCIs and IAIs. So that's major capital improvements and individual apartment improvements. Also getting rid of luxury decontrol, and there's a slew of changes that have taken place. So you really have to go backwards in order to go forwards. You can't buy a building with a blindfold on. You have to know what you're buying, and you have to make sure that this was done properly. And if it wasn't, there's definitely risk that a buyer has to take on.
Yeah, I feel like there's some buildings that don't have the proper paperwork, or in some senses like illiquid assets. In some cases,
we were looking at a deal together, and there were gaps. If you look back on the lease history, there were gaps in a lot of these leases and documents on the buildings.
Yeah, it's just putting a lot of pressure on the owners. A lot of owners that we're working with don't have paperwork going back 15, 20 years, and the city keeps coming up with new ways for owners to really be affected by not having that paperwork. We've heard about the Regina case getting appealed and so forth. I think another really concerning thing that we're seeing in the market that is being really talked about all over the place are low maturities. Pretty much, any owner that took out max leverage between 5 and 7 years ago has to come up with some sort of cash in refi to be able to continue to hold on to these assets. So we're advising a lot of clients as far as what the properties can actually get in today's market, and whether it makes sense for them to put more money into the deal and hold on to the building, or to actually sell the asset. And then going back to regulations. Unfortunately, the city got rid of completely of combining apartments. So used to be able to combine two adjacent rent stabilized apartments, reset a new rent at market rate, and keep that rent stabilized. That actually got shot down by DHCR this week, and then some amendments to substantial rehabilitation. Just a quick overview on what substantial rehabilitation is. If a building is 80% vacant or higher, it could qualify for substantial rehabilitation, which means that you can actually deregulate the whole building if you replace 15 of the 17 systems within a building. And the building must be in quote-unquote some standard condition. That used to be a kind of a gray area. But now a lot of feedback that we're getting from buyers who were doing sub-rehabs in the past is the building basically has to be almost dilapidated to actually do substantial rehabilitation. So it's just putting more and more pressure on owners. There's less and less ways that investors can really add value to these buildings and complete their business plans here.
It's interesting because there's just increased regulation on the current housing stock. We've been talking about 40,000+ warehouse rent stabilized units in the city. However, there's no replacement for the 421A to promote new housing in New York. So that's the disparity that we're really seeing.
Yeah, no. So, those are a handful of the relevant market topics that we found to be of interest. We obviously hope that this quarter 3 update was useful for you. And if there's any way that Justin, Zach, or myself, or anyone at IPRG can be a service to you or add value to your real estate business, feel free to reach out. And we really appreciate that you carved out the time to hear us out today. So,
Yeah, thank you.
Thank you very much.